Good morning, everyone. Today is the second session of Forex Exposure and Risk Management module. In the first session, when we had introduced the concept, we learned following 5 to 6 concepts. First was what is foreign exchange, what is foreign currencies that we are dealing in, the types of transactions that involves foreign currency, then how do you calculate return on foreign currency, how does return get impacted for one person investing in another country or in another currency. Then in that case, we computed the stock return, currency difference, and then we also calculated factor on factor return, right? We calculated by both direct method and indirect method over here in order to arrive at that return. We also devised out of that the steps in calculating the return percentage. Then we had discussed about the codes of currency, direct code and indirect code. What is direct code? Direct code is basically, for example, if my currency is rupee, so when I go to the market to buy something, I'm obviously not going to ask that person, what can I buy in 1 rupee? Rather, I ask, what is the price of this particular commodity? So say, for example, I'm buying potato. I'll ask the person, what is the price of potato? He is going to tell me, let's say, for example, it is 40 rupees per kg. So I know this is a direct quote, right? For that particular commodity, how much rupees I have to pay. That is direct quote. Indirect quote is essentially for 1 rupee, how much of potato I can buy. That is indirect quote. Not a very, very scientific means of addressing it for the simple reason my currency is rupee. So I obviously am thinking in terms of how much rupee will be required for each commodity. But nonetheless, these are the way of quoting direct and indirect quotes. Thereafter, we also covered the concept of how the quotes are being done in terms of American term or European term. American term is basically quoting everything in terms of USD in the numerator. Meaning, say for example, if you want to buy something, then you are going to say, okay, what is the price of this particular commodity in USD? Which means any other foreign currency is basically going to be quoted as a base currency. In European term, the concept is reverse. All the foreign currency gets quoted in the numerator and the base currency is known as USD. Like for us, if you see the direct quote over here, if you consider direct quote and indirect quote over here, then you can see over here our direct quote and European term, they are very similar, right? Because we always quote things or commodity in number of rupees. So it is very similar to indirect, direct quote. European term is very similar to direct quote, right? And thereafter, we also looked at how to compute appreciation or depreciation in the currency, how to compute appreciation from the depreciation of another currency or vice versa, right? Because whenever there are two currencies, one appreciates, in that case, the other one obviously depreciates. So this is where we had stopped in the last session. Now we are going to go further ahead and build on that. So today I am going to start with two-way quote, right? To start with, two-way quote. What do you mean by two-way quote? So two-way quote is basically, we generally talk in terms of bid and ask. Now, first of all, what is the meaning of bid? What is the meaning of ask? So bid is generally considered to be also known as sell rate, right? So when I go to the market and I ask the banker or the forex dealer, what is the rate for this particular currency? Then they are generally going to give me two rates, which is known as bid and ask, meaning sell rate and buy rate. So say for example, if USD1 is quoted as equivalent to rupees 78 and rupees 80. What is the meaning of this? So bid is nothing but the sell price. But who is going to sell at this price? Is it the banker who is selling it at this price, or is it the customer? So when I go to the banker or to the forex dealer, this is the price at which customer is selling to the banker or the forex dealer, right? So it is a sell price for me. When I am giving him dollars, if I give dollars to the bank or the forex dealer, right? I am giving him dollars, he is giving me rupees. So how much rupees will he give me? He will give me 78. Now, obviously, this bank is not going to keep the dollars and sit on it. They are essentially going to sell this dollar again to another customer, right? So they will give dollar and then they will essentially get rupees for that. So they are going to sell those dollars at what rate? They are going to sell it at 80 rupees, right? Now, you may say, what is the difference between this particular price? So obviously, bank is not a charitable institution. It needs to earn some profit or margin in between, right? So 80 minus 78 is basically nothing but the margin for the bank to do this transaction of buying from one person and selling to another person, which is known as spread, right? Which is known as spread. I repeat once again, what is the meaning of bid? Bid is that price at which you sell the currency. Who will sell the currency? It is the customer. Customer will sell the currency to the forex dealer or the bank. Similarly, buy rate or ask rate is the rate at which customer will essentially buy. Right? Now, as customer is selling at this particular price, it also means that bank is going to buy at what price? Bank is going to buy at bid price and is going to sell at ask rate, right? So bid rate, ask rate. Now generally, obviously, because bank has to make some margin in between, your ask rate is obviously bound to be higher than, so bid rate is obviously going to be lesser than your ask rate. What is the reason for that? Because there is a margin to be kept in between for the banker, which is known as spread. Okay. Now let us take one example. So before, I'll just establish over here, spread is nothing but ask rate minus bid rate, right? Now let us take an example of a currency So say for example, if I'm going to have over here a currency code which is given to me by, say for example, ABC Bank. ABC gives me a code for every dollar, right? It says that it will provide me rupees 81.63, rupees 81.94, right? This is the code which is being given by ABC Bank. Now, there is an exporter who is going to receive 200,000 of US dollars. So 200K US dollar. Let me put this into 200,000, 2 lakh. 2 lakh dollars he is going to receive, and he wants to essentially convert this into INR. So is he going to sell or is he going to buy? Yes. Exporter has received payment of
He's going to sell, sir.
So he is going to sell to the bank, right? In other words, bank is buying this. So this will be at what rate? Bid rate or ask rate?
Bid rate.
This will be at bid rate, right? Now say for example, if there is another importer who needs 100,000 for making payment of some imports which he has made, right? So he is supposed to pay this money, which means he has to buy $100,000 from the bank. So bank is going to sell it to him at bid rate or ask rate?
Ask rate.
Ask rate, right? So I have 81.94 at which bank sells it to the importer, right? Let us take one example further from the assignment sheet which we have. This is question number 4 in the assignment sheet. So without worrying about what is nostro vostro account, because that I will cover after this question is covered, here it actually does not have a significance, strictly speaking. That is the reason I'm taking this question prior. Okay. Now, ABN AMRO Bank, Amsterdam, wants to purchase rupees 15 million against US dollar for funding their nostro account with Canara Bank, which basically means that they have a bank account with Canara Bank. Okay. And for this, they are assuming interbank rates of US dollar is rupee 51.3625 slash 3700. What would be the rate Canara Bank would quote to ABN AMRO Bank? Further, if the deal is struck, what would be the equivalent US dollar amount? So first and foremost, what is to be understood by us is here there is a particular transaction in which we have over here Canara Bank, right? Canara Bank, and then we have here ABN AMRO from Ahmedabad. Sorry, Amsterdam. My mistake. Amsterdam. Chalo. So we have Canara Bank and ABN AMRO Amsterdam Bank. Now, what do you mean by they want to essentially fund their nostro account? So they have opened an account with Canara Bank, right? And in this account, they want to keep some money. How much money do they want to keep? They want to keep over here rupees 15 million. 15 million is 1 crore 50 lakhs, right? 1 crore 50 lakhs. That is what they intend to fund in their account. Now for that, obviously, they will have to transfer dollars. Am I right? So they need to give dollars to Canara Bank, and Canara Bank in turn is going to give them rupees to ABN AMRO Bank, right? Now, the question is, what would be the rate that Canara Bank would quote to ABN AMRO Bank? So is Canara Bank going to buy or sell? Yes, we have two rates over here, first of all.
Canara Bank will sell.
Yes, Canara Bank is going to sell. Sell what?
Sell rupees to, sell dollar to Amro Bank.
No, ABN AMRO Bank, you can see over here, wants to purchase rupees, right? 15 million
Rupee.
against US dollar.
Yes.
So what is going to happen is ABN AMRO Bank is going to give you dollars and Canara Bank is going to give them rupees.
Rupees.
Right? Now the rate which is given to us is 51.3625 3700. So can you please help me? Which one is bid rate? 51.3625 or 51.3700? Yes. What is the bid rate?
51.3625.
537.
3625. Always remember, ask rate is going to be higher than the bid rate, right? Because there has to be a margin which has to be accommodated for the forex dealer. So ask rate is 51.3700, right? Now this is the bid rate and this is the ask rate. This is the rate at which who is going to sell? Customer sells to bank, right? This is the bid rate. Now here ABN AMRO is going to sell dollars to Canara Bank. So Canara Bank is going to give them at what rate? 51.3625 or 51.3700. ABN is over here a customer, right? This is a customer. So customer is essentially selling dollars to Canara Bank. At what rate?
51.3625.
51.3625, right? So the rate which will be applicable is 51.3625. Now the question which is being asked is how much money will be required for this 15 million? So how much money will be required? Yes. How much money will be required? I have over here 1 crore 50 lakhs divided by 51.3625, right? So I'll have 292 $292,041 $0.85933. This is the dollar which ABN Bangalore will need to ABN Amro Bank will need to sell to Canara Bank to get 15 million rupee or 1 crore 50 lakh rupees in their account. Right? I repeat once again, in this particular question, ABN Amro Bank wants to fund, they want 15 million rupees against US dollar, right, from Canara Bank, New Delhi. So assuming the interbank rates of US dollar is 51.3625/3700, what would be the rate Canara Bank would quote to ABN Amro Bank? So for Canara Bank, they are essentially going to buy US dollar. So if customer is selling, that means it's a bid rate which is to be charged, right? Because Canara Bank is buying it. So Canara Bank will offer 51.3625 rate to ABN Amro Bank. Now, in order to convert or get 1 crore 50 lakhs, in other words, 15 million rupees, they would need to bring in how much? They would need to bring in, we divide 1 crore 50 lakhs with 51.3625, what we get is $292,041. Right? Now, this basically gives rise to two concepts over here. So, coming back over here, bid rate so when I say bid rate is basically nothing but the rate at which customer sells currency, right? Currency to bank. Am I right? Or forex dealer, FX dealer. Similarly, ask rate is rate at which customer buys currency from bank or forex dealer. right? Now that I have the quote available to me, which we have seen over here, this is the two-way quote which is available. How do I convert this quote into the opposite of it? Meaning, first and foremost, my question over here is this a direct quote, a direct two-way quote, or an indirect two-way quote?
Indirect
It is
for
a
a bank in Amsterdam.
for a bank in Amsterdam. We are right now talking about the quote is provided by which currency? We are right now in India. So let us take it for India, for Canara Bank, that is. In this particular case, when the quotation is given like this, where rupee is quoted for dollar, right? The currency which is quoted is rupee is given to you 81.63 per dollar. So
Direct quote.
this is a direct quote, right? Because the dollar is essentially being quoted just like any other commodity would be, right? How much rupee would I need to pay for every dollar? That is what is being quoted. So this is a direct quote. So how do I convert a direct quote into an indirect quote? And is that relevant for me?
Sorry, sir.
I repeat once again.
Sir,
Say
sir, I
for
want to
example,
ask something.
yes, yes.
Sir, if the Canara Bank is paying 51.3625 rate, sir, so
Hmm.
he will be in loss, sir. Canara Bank will be.
How will Canara Bank make a loss? When Canara Bank essentially
It is
buys it,
paying $292,000,
yes,
and if it sells in if it do transaction ask rate, it will give in 51.370. It will become $291.
So it was the same doubt for me also, because if we say Amsterdam Bank is purchasing rupees against dollar, means the bank is selling dollar to another bank, and the Canara Bank is a customer for purchasing that dollar. If we
yes.
interpret that way, then our calculations will reverse.
All right. So first and foremost, let me reiterate over here. Bid rate means it is a rate at which customer is essentially going to sell to the bank. So if you are a banker, for banker, these rates are basically reverse. Would you agree to that? What is a sell rate for me? I am the customer right now, let's say, for example.
Yes.
Okay. And these are the rates which are given by the bank. So let's say, for example, here there is Canara Bank. Right? Here there is Canara Bank. They have given me these two rates, 51.3625 and 51.37. Now, you know for a fact, bid rate is basically the rate at which customer, I am the customer right now, say for example. So I am going to sell the dollar, right? I am the customer. Customer is going to sell the dollar to the bank, and bank is going to buy at 3625. Are you with me?
Yes, sir.
And
Yes,
then the
sir.
same $1, when any other customer is going to be there who needs dollar, right? Because remember, I mean, on a global scale, we are still net importers, right? So there are obviously other importers who need dollars because they have to make their payments in dollar terms. So I have another customer, Canara Bank gets another customer. So Canara Bank is going to sell this same dollar to them at what rate? 51.3700. Are you with me?
Yes, sir.
Right?
Yes, sir.
So what is the margin for them? What is the spread or margin for them? 51.3700 minus
0.375.
51.3625. So in other words, 0.0075 per dollar is the spread which the bank has. Are you with me?
Yes, sir.
Yes, sir.
Okay. Now the specific question that you asked, since this is the rate at which customer is selling to you, in other words, this is the rate at which bank will buy, right? So what is the sell rate for the customer becomes the buy rate for the bank. Are you with me?
Yes, sir.
So bank is buying at 51.3625. Over here, it gets $292,000. Now, you are asking how will the bank essentially make money? So if bank is going to sell the same to the other customer, it is going to sell it at what rate? It is going to sell at 51.3700, right? So it will make how much money over here? Can you see that? You had essentially given what? 15 million rupees. Now you are getting 15 million plus 2,190. So what is the spread over here?
2190.31 margin.
Exactly. So 2190 becomes the spread over here for the bank.
So because customer here is a bank, that's why we get confused.
Yes. So the best way to essentially remember is.
Students, Amit, can I add one thing?
Yes, sir.
Student, please always remember, generally what happens, it is always in our mind that bank has always a upper hand. But remember one thing, when bank becomes a customer, he loses or she loses his upper hand. So ultimately he becomes a normal customer. So that's that's why you may be getting confused for there. Am I right?
Yes, sir. Clear, sir. Now.
Now
Thank
clear?
you.
Okay, better.
All right. So now when I talk about direct quote and indirect quote, right? So I was coming back to that direct quote and indirect quote. What do you mean by direct quote, indirect quote? So here, say for example, I have a quotation available from a particular bank, right? Which says that they will provide me $1 at the rate of say rupees 78 and rupees 80. I am taking these whole numbers just for the ease of reference, right? For this example. So let's say, for example, I am getting the two-way quote as 78 and rupees 80. Now, as you know, here I am essentially quoting based on, it is per $1, right? This is per $1. So this is nothing but direct quote. Am I right?
Yes, sir.
Now, when I have to convert this into indirect quote,
Bid is 1 by 80 and ask is 1/78.
so here, how do I convert this? So will it be over here? Normally what we do is direct to indirect.
Becomes reverse.
We just do the reverse, right? That is reciprocal basically. So if it is direct quote is say for example rupees 78, then indirect quote will essentially be 1 upon 78, right? That is what we had learned in the last session. Now, when I'm talking about a two-way quote, in this case, you will need to remember that your bid, when reversed, will become the ask or the indirect quote, right? So in the indirect quote, it will get opposite. So bid will become ask and ask will become
Bid.
right? So here I will have 1 upon 80 and 1 upon 78. So you might obviously ask me over here, sir, why is that so? You can do this particular calculation over here as well. Let's say, for example, I am going to do the valuation, right? Again. So let me do the calculation equal to 1 divided by 80. What is the value? 0.0125. If I say 1 divided by 78, it is 0.01282. So which one is a higher value?
1 upon 7.
0.01282, right? This is, you can see over here, this is 0.125, this is 0.0128. So which is bound to be the bid price? The lower price is generally the bid price because that is the price at which bank will essentially buy, and higher price is the price at which the bank will generally sell. Now, for remembrance purpose, you can always remember that direct quote to indirect, when you do, not only you need to do reciprocal, but also bid will become ask and ask will become bid. But what is the logical reason? If you want to remember it logically, how do you go about remembering it? So let me take it this way. Okay. All right. Now, bid price is that bank is going to, it is 78, right? We spoke about it. Original direct quote is 78 rupees, right? So basically, bank is buying $1 at 78. Am I right? In other words, can this also be said that bank is actually selling rupees? Yes, bank is buying dollar and bank is selling rupees, which is 78 for every dollar. Yes? Does that make sense? So
Yes,
bank
sir.
buys $1 at 78, which also means that bank is selling you rupees 78 for every $1, right? So what is the rate in that case when you do the ask and bid, right? So here, when I am going to essentially ask for that particular price at which I am going to sell, because here I am essentially talking about the rate of which currency I am converting this into now dollar rate, right? Indirect quote. So for every dollar, what is our so bank is going to essentially sell how much for rupees 1 is equal to how much dollar will you get? $1 upon 78. Now bank is going to sell. That means what is bank going to buy? Hello. Remember, I again would like to quote over here bid and ask. This is for sell is for customer, right? Which means this is the rate at which bank will buy. Ask is nothing but buy. Buy for whom? For the customer. So bank is going to essentially sell. Am I right?
Yes, sir.
So now bank is going to sell to you at what rate over here?
Ask rate.
1 upon 78, right? So your bid, when reversed, became ask of the quote. Similarly, I can also say over here, right? Let's say, for example, if bank is, when I say 80 rupees, bank is essentially, bank sells $1 at 80. That means bank buys rupee, right? At what price? If bank is selling $1, that means bank is buying rupee at this particular rate, right? 1 upon 80. Are you with me?
Yes, sir.
And this now comes over here, right? Because bank buys at the rate of this rate, which means customer has to essentially sell at 1 upon 80. So generally, for simplification purposes, if you don't want to remember this, the concept is this, right? But if you want ease in remembering it, remember from direct quote to indirect quote, it's always the reverse, that is inverse, right? However, your ask will become bid and bid will become ask in indirect quote. Is that clear to all of us? Yes?
Yes, sir.
Okay. All right. Now, there is one more aspect to be covered in this. So say, for example, yes, last lecture or last session, we had also discussed about what is the meaning of cross rate, right? So how do I go about computing the cross rate? Let me put it this way. All right. Okay. So what is the meaning of cross rate, by the way? Any ideas? What is the meaning of cross rate? Say, for
We're using
example,
two different
bolo bolo.
we use two different currencies other than the base currency to make the conversion.
Yes. When you don't have the direct quote available between the two currencies, but there is a common currency in between which you can use for obtaining the quote for the third currency. So for example, let's say we have USD1 is equal to rupees 80, right? And then we are told GBP1 is equal to USD 1.20, right? Now, I want to basically identify what is going to be the rate between rupees and GBP. So how do I go about it? How can I calculate that? Yes.
Convert GBP into USD and then USD into.
Exactly. So what I can do is, I know for a fact that here I have GBP to USD. We had seen that last time around also, in last session, that is, when we discussed about how to convert, right? So when you are going here, if I am going from, let's say, I have GBP1 is equal to USD 1.20, which means it is basically a quote of GBP being the base currency or the quoted currency, right? So when you are going up the ladder, then we do multiply or divide?
Multiply.
Then we multiply. And here again I have given rupees upon USD. So again I am going to convert dollar into rupees, so I will say multiply. Now what I am going to do over here is I have $1.20, which I already know, right? So now I am going to replace that particular value over here. So rupee upon 1.20. Remember how much was the rate over here for rupee? Rupee rate was 80, right? So now I want to find 80 rupees was the rate earlier. So 80 should be divided by 1.20 or should it be multiplied by 1.20? Yes. For $1 is 80 rupees. So $1.20, because 1 GBP is equal to $1.20, will be how much? So I will essentially say 1.20 into 80. Am I right? Exactly what I was talking about is when you are going up the ladder, you multiply, right? So here you will get 1.20 into 80 as 96 rupees. So you will find 1 GBP is equal to rupees 96, right? Now here there was a single quote available. What happens when we have the two-way quotes available? Then how do you do the conversion? Because I will need to find the ask rate and bid rate for the currency. So how do I go about it? Yes, any ideas? Yes. So say for example, I take the same over here, the same example over here, right? So we have the dollar quotes available to us, rupees 80, comma, rupees 82. Similarly for GBP, the quotes available are USD 1.20, comma, USD 1.30. Now you have to find what will be the bid price and ask price, for which rate I want basically GBP to rupee. Okay, I want to find GBP to rupees. So how do I go about finding that? Yes. So how do I go about doing that? Remember, this is the bid rate, this is the ask rate, right? So in order to find the bid rate of GBP, let's say for example over here, I'm going to say, I want to find the bid rate of which currency I want. I want GBP to rupees, right?
So
GBP,
80 multiplied by 1.3
yes.
or
Okay.
82 multiplied by 1.2.
Okay. So first of all, how do I go about it? Because I would basically need the bid price, right?
Yes, sir.
So
Sir,
I
sir, buying a dollar and selling it on US GBP 1.3.
so GBP upon USD, I want this bid rate, and then I want to essentially, but this particular thing you can see over here, I want, what I want is, I want GBP to be the base, right? To be the quoted currency. So I want GBP in the denominator. I want USD over here in the numerator. Probably, mathematically speaking, wouldn't this serve me better
Yes,
when
sir.
I'm doing, say, for example, rupee upon USD? Because then I can say USD gets cancelled, rupee upon GBP rate is there,
0.3 Rajaka, right.
right? So here I have bid. I want this also to be bid. But the challenge over here is, do I have USD per GBP bid available to me? Yes. Do I have the,
So 1.2 is bid, right?
okay,
But
USD
but
to
but
GBP? What is the
but
bid
but
price?
sir,
USD to
when the
GBP?
cross price is here, then 1.3 is bid.
USD to GBP 1.2 or 1.3?
1.3.
Because I'm trying to convert what? From GBP to USD. So you are going to sell which currency?
Dollar.
Dollar.
Or GBP to USD. You are trying to convert from GBP to USD, right? So I want to buy dollars. Let me put it this way. This is bank, right? This is customer. Now customer has £1 over here. Okay. So he's going to essentially, he wants to exchange with bank. What does he want over here? He wants dollar. Am I right?
Yes, sir.
So what is the rate he is going to get over here? Remember the rates are available over here. GBP1 is equal to, you have USD 1.20 and 1.30. So bank is going to give you how much dollars? 1.20 or 1.30?
1.3.
Why 1.3?
Bank is selling USD.
Okay. Bank is selling USD and it is buying what?
GBP.
GBP. So what is the quoted currency? Is it the GBP or the USD? The rate is, this quoted rate is mentioned. What is the base currency over here? GBP or USD?
GBP.
GBP.
Right. So when I give them £1, bank is going to give me a dollar. Dollar of how much? Are they going to give me 1.20 or 1.30?
1.20, sir.
1.20. Remember, bid price is the sell price for the customer, right? I am the customer over here. So what is the bid price for me? Bid price for me is 1.20. So I'll get only $1.20. Are you with me?
Yes, sir.
Right? Dollar with me. And I want to sell $1.20. Okay? What is the
Yes,
rate I'm
sir.
going to get for each dollar? What is the bank going to give me? Is dollar the quoted currency? Look at it over here. What is the base
40
currency?
rupees.
Base currency is USD, right?
6.
96. Right? Now this is for the bid price. This I got is GBP to rupees bid price over here, which is 96. Now same
Sir,
thing I want to do with ask also.
sir,
I want to find, yes.
sir, here is base currency is rupees, right?
No, base currencies, you can see what is the rate.
तो आप हम कैलकुलेट कर रहे हैं.
See, we are calculating, this is the rate which is given is rupee upon dollar, am I right?
GBP अपॉन डॉलर रुपीस कर रहे हैं ना.
हाँ, हमने जीबीपी से डॉलर कन्वर्ट कर दिया बेटा. डिड वी कन्वर्ट
सर ये
जीबीपी इनटू डॉलर्स?
96 निकाला, 96 जो हमने निकाला है वो बेस प्राइस इज रुपी फॉर रुपी,
Yeah, this is rupees.
राइट.
So this is exactly what we are calculating now is GBP to rupees, right?
यस सर.
Because I have got the quotation of rupees to USD and rupees to USD to GBP. I want to find what is the quote going to be for rupees to GBP. Sorry, this is not GBP to rupees. This is rupees to GBP.
सर से इसीलिए पूछा हमने 96 लिखा है हमने.
My mistake. So we are trying to find rupees per GBP.
ओके सर.
Yeah. So it is basically over here also you can see USD gets cancelled. It will be rupees per GBP.
So that's why I told you 1.3 last time.
So this is rupees per GBP. Okay. Now
Yes.
same thing I want to do for ask also. So again ask I want to find what is going to be rupees per GBP. Ask. So how will I get that? Again I need to multiply it with, first of all I will say USD upon GBP ask, multiply it with
rupees upon US.
I am going to say over here I want USD upon GBP ask multiplied by rupees upon USD ask. Right? So USD upon GBP ask is how much? 1.30 multiplied by
82.
upon USD ask is what is this? 82. So I will get, what is the answer over here? 82 into 1.30. Yes, what will be 82? 82 into 1.30. So that is 106.6. Right? So I'll get over here 106.60. 106.60. Right? Okay. Shall we take one of the examples like this? One more. Right? Because cross rate conversion is going to be an important element even from examination perspective. So we will take one which is a similar example and one where there will be a reverse element, right? So that we can get a good practice around it. So all right. Now let us take another example. Okay. Another example. USD quote is available, right? In rupees 80 and rupees 81. Then again USD quote is available at CNY 9, comma CNY, that is Chinese yuan. Now what I want you to compute is CNY to rupees. So how do I go about this? Yes. So I need to calculate over here what? See, you want to calculate CNY to rupees, right? Bid, ask. What will be the rate over here? How do I go about it? Yes. So CNY to rupees will be equal to rupees upon USD ask price multiplied by, yes, multiplied by, what should I multiply it with? Should I multiply it with CNY upon USD over here again? Or does it have to be the other way around, USD upon CNY? USD
USD.
upon CNY. Again, I will need ask. Am I right? Now, rupees upon USD ask is available to me, which is 80. But I do not have USD.
Sir, again, I have same question. What we calculate, CNY upon rupees or rupees upon CNY?
We are calculating now CNY upon rupees.
The quote is you are telling us rupees is upper side and CNY is
On CNY. Okay? Sorry. Chalo. Yes. So here, when I am doing multiplication, rupees upon USD into USD upon CNY. So I get rupees upon CNY, right?
yes, sir.
C. Chalo. Yes. So I have one rate available, rupees upon USD, which is 80 or 81. I am first of all calculating ask.
81.
So 81. 81. Okay. Multiplied by. I want to calculate USD upon CNY. Do I have USD upon CNY ask, or do I have
Yes.
what I have the quotation available to me CNY to USD, right?
Yes, sir.
So I need the ask price of the reverse. That is, I need to do this into inverse quotation. So how
1
do I
divided by 9. 1 divided by 9.
It will be
1
So
divided by 9.
divided by 10.
1 upon 9 and 1 upon 10. But remember, bid price becomes ask price and ask price
Ask
becomes
price.
bid price. So here I will have the bid
1
price
upon
will
9.
become ask price, right? So it will be into 1 upon 9. Am I right?
Yes, sir.
So I will have over here this comes to 9. Is everyone with me?
Yes, sir.
Yes,
Right?
sir.
So this comes to 9. So I have found the ask, which is 9. Now I need to calculate the bid. This is ask. What we calculated is ask. Now I want to calculate the bid. So how do I do that? Yes, I want to calculate now is bid. Yes. So bid price is what? First of all, I need to find rupees to USD. Rupees to USD is available to me. So bid price is what? 80. Am I right?
Yes, sir.
Into, now remember USD to CNY quote is not available. The quote available is CNY to USD. So you need to inverse the quote. When we do the inversion, then bid will become ask will become bid. I want bid price. So I need to check what is the ask, and that will become 1 upon
10.
right?
8.
So I have 8 over here. Now, one way to again cross-check subsequently is always to check if the ask price is higher than the bid price. Is the ask price higher than the bid price?
Yes, sir.
Yes, sir.
Because you need to provide for the margin, right? The difference is the spread. Ask minus bid is the spread. Ask price generally is always higher than bid price. Shall we take one more example? Let's take one more example. So let's take a USD quote is available to me, and now I want to calculate, let's say, KW, Korean won. The Korean won is 1018, comma, Korean won 1036. Okay. And we want to calculate the quote of rupees to Korean won. Rupees to Korean won. Okay. Yes, let's start now. So how do I do that? Rupees to Korean won. First I'll calculate for ask. Yes. I'm going to multiply first and foremost. I have the quote available, rupees upon USD asked multiplied by USD upon Korean won asked. Now the quote which is available is Korean won to USD, right? So USD to Korean won is not available. So I need to inverse the quote. Rupees per USD ask is available to me. Rupees per USD is how much? Rupees per USD's ask is 81 multiplied by, I want USD to Korean won. Now remember, this is an indirect quote, so bid will become ask. That is
1 divided by 1018.
18. So I am getting over here ask price is 0.07957. Right? Can we do the bid now? Yes. I'm going to calculate over here. Rupees to USD and KW. So rupees to USD bid is available to you, which is 80. You need to multiply it with. Now remember, this has to be inward. This is indirect quote. We don't have the direct quote available. Direct quote is for KW upon USD. So I need to do the inverse, in which case ask will become bid. So it will be 1036 inverse. Right? So I get. Now as a measure of kind of cross-checking, is there any error being made? You can always see bid is less than ask. So there is some amount of mathematical validation that ask has to be higher than the bid price. Are you all with me so far? Yes?
Yes, sir.
Okay. Shall we see one sum in that case now? We have question 5 from the assignment sheet which I had shared with you guys. Is it visible to all of you clearly? Okay. If you don't have the sheet right now immediately available, at least you can look at it on the screen. XYZ Limited Bank, Amsterdam, wants to purchase rupees 25 million against pound for funding their Nostro account. Nostro account is nothing but basically their account with the other bank. Okay. And they have credited Loro account with Bank of London. Calculate the amount of pounds credited. Ongoing interbank rates are per dollar. Now, before I start with Nostro and Loro, since both these concepts are now getting discussed, let me briefly give you an idea about what is Nostro and Loro, right? A very brief idea basically. So here, okay, all right. So say for example, here we are talking about, I have 3 banks over here. Say for example, ABC Bank, okay, this is an Indian bank, okay, Indian bank. Now there is another bank called, let's say, Citibank. This is New York, US, right? Now, for facilitating, the Indian bank basically has opened an account with Citibank over here. So Citibank has an account here with them of ABC Bank. So just like any other customer, ABC Bank has now become the customer of Citibank. They have opened their own bank account over here, right, with Citibank account, which is in which currency? Which is in the currency of the local country over there. So it is a US dollar currency account, right? Not INR account. I repeat once again, Indian bank, whose home currency is obviously rupee, has opened a bank account with another foreign bank in foreign currency account, right? So it is in a foreign bank, yes, Citibank, New York, US, and I have opened a bank account over here, right, which is in USD, foreign currency, right? So this account has been opened by ABC Bank so that they can do transactions in USD, right? Because USD is not their home currency. Now, this account, which is opened with Citibank, this is known as Nostro. Nostro account, right? So for ABC Bank, this is called as their Nostro account. Are you with me? For ABC Bank, this is called as Nostro account. So it is basically nothing but my account in your bank, right? My account in your bank. So I have opened a Nostro account over here. Now, the same account, since Citibank is an international bank in US, it recognizes ABC is an Indian bank which is opening a US dollar account with us. So they refer to it as Vostro account. It's the same account, but Citibank calls it as Vostro account, while Indian bank calls it as Nostro account. What is the meaning of this? Nostro means my account with your bank. Vostro means your account in my bank. It is the same thing. However, the reference point is different in the sense that I am essentially referring to your account with me and saying this is your account. And obviously you are saying the same account. This is basically your account. Are you with me? Right?
Sir.
Now, the question that arises is, what is the meaning of Loro account? So I have over here, you can see a Nostro account with Citibank, New York, where I am holding USD, right? However, I want to essentially make payment to, say, for example, Bank of Scotland, I want to do some transaction with Bank of Scotland, right, which is to be in pound. But I don't have an account with them directly, right? So what do I do in that case? Now I don't have this account. So what do I do in that case? This is called third party, right? This is a third party. So how do I essentially deal with third party? I can pay them in dollar terms, but I can't pay them in pound. Nonetheless, Citibank is in a position to do that because Citibank has their own account with Bank of Scotland. Citibank has their own account with Bank of Scotland, right? So now, just like we do the cross rate conversion, here also the same thing will happen. However, this third account is known as Loro account. This is not my account, right? It is a third party account, which I am going to utilize. So say, for example, if ABC Bank has a customer reaches to ABC Bank, it's an Indian customer who tells ABC Bank that I want to pay 1000 GBP. 1000 GBP. Okay? To a person who has an account in Scotland. I want to pay this 1000 GBP to a person who has an account in Scotland. Are you with me? I repeat.
Sir, this ABC Bank is in India, no, sir?
Yes, yes. ABC Bank is in India. So, for example, me or you, right? Say, for example, we are pursuing some education or pursuing some business, and I want to essentially pay. Like, I want some journals, right? From, let's say, Great Britain. Now, I am essentially reaching out to my ABC Bank, which is an Indian bank, where I have the account. So, I tell them, sir, I want to pay 1000 GBP to so and so person who is in Bank of Scotland. Now, ABC Bank does not have their own account with them, right? Because they don't have a Nostro account with Bank of Scotland. But they know for a fact that Citibank has their Nostro account with Bank of Scotland. So what they do is they issue the instructions to Citibank. Let's say this 1000 GBP is, say, for example, worth $1,200 of dollars. Okay. So it is going to essentially instruct Citibank that for my customer, you from your account, please pay to so and so person 1000 GBP. Okay. And then you can debit it into my account in USD terms. Because I am a customer over here, remember? I am a customer with Citibank. ABC Bank over here now, it's not a bank anymore, it is a customer for Citibank. So customer is asking Citibank, you please make a payment to Bank of Scotland. So now Citibank is using their Nostro account, going to instruct the Bank of Scotland, you can debit 1200 or 1000 pounds in my account, basically over here. Are you with me?
Yes, sir.
Okay. I repeat once again the entire process just so that there is no confusion. Okay. So ABC Bank is an Indian bank which has a rupee currency accounts in India. However, it has chosen to open a bank account with Citibank, New York, US. So it is a foreign bank where they open their bank account in foreign currency, which is USD over here. Right? So this account is called by ABC Bank as Nostro account. Citibank calls the same account as a Vostro account, meaning your account in my bank. It is the same account, right? Indian bank will call it as Nostro account. Citibank will call it as Vostro account. Now, if I want to do some transaction in, say, for example, I have to pay in US to somebody, then essentially, just like you draw a check, right? So ABC Bank is going to instruct Citibank, you debit my account and pay to so and so person in USD, and the Nostro account will be debited. But now, one of my customer has reached out to me saying, I want to pay GBP so and so money, 1000 GBP, to a person who is in Scotland. So he's saying that you pay to this particular account, which is in Bank of Scotland, 1000 GBP. Now, ABC Bank do not have their own direct account with Bank of Scotland. But they are aware that Citibank has their account with Bank of Scotland, right? And with Citibank, I have an account. So I am the customer. ABC Bank knows that I am the customer for Citibank, right? So they have already taken the money now from customer that, okay, I will transfer GBP 1000 on your behalf. Now they instruct Citibank, please debit my account and you pay to so and so person in Bank of Scotland, right? Now Citibank has their account with Bank of Scotland, and Bank of Scotland will debit the Nostro account of Citibank. Are you with me? Citibank has their Nostro account with Bank of Scotland. Bank of Scotland will debit their account and essentially the payment will get effected. Now for an Indian bank, for this Indian bank, for ABC, when I am using the account of Citibank's Nostro account with Bank of Scotland, I call it as Loro account. It is a third party account, right? It is neither Vostro nor Nostro. It is a third party account which I am taking benefit of, from where the payment ultimately will be made. So that is called Loro account there. So it is, this is my account, Vostro means your, and Loro means there. Okay? First party, second party, and third party. Is that clear?
Yes, sir.
Okay.
Yes, sir.
Now let
So
us
this is
read the question
internationally
again.
accepted things.
I'm sorry.
So this is internationally accepted things. Nostro,
Yes.
Loro, and Vostro.
Yes. So how do the transactions basically happen? Say, for example, you are in Russia, I am in India. Okay. I am a bank, you are a bank. We want to transfer some money. Then how would we do that? Because we need a centralized bank, right? In between.
Yes, sir.
Like in India, if I want to transfer, say, for example, 5,000 rupees into your account. So nowadays with UPI, etc., it seems that everything is seamless. Directly it is going into your account. But as a matter of fact, all the payments, any customer who wants to make the payment, right? That payment would get routed through eventually RBI, right? Because RBI is the clearing bank. Am I right?
Yes, sir.
So it will go from RBI. Now, when you don't have RBI in between, the central banks, these are different countries, right? So in that case, since I don't have the RBI available to me, now what do? I open an account into your bank, you open an account into my bank. So we both open something known as Nostro account, right? Are you with me?
Yes, sir.
So now anytime we do transactions, what will you do? You will essentially just issue the instruction that you can debit so and so into my account or credit so and so into my account. You want me to give you a simple example? Let's take a simple example. Chalo. Now, A bank and B bank. Okay, these both have opened their account with each other. So in B bank account, you will have A bank account. Are you with me? And similarly,
Yes.
in A bank, you will have B bank account. Are you with me? Both are opening account with each other. This A bank is in India, okay, and this B bank is in Russia. Are you with me? So they both have opened account with each other's bank. Now, there is a customer of A bank, right? He says, I want to pay ruble 50,000, okay, to XYZ. And he gives this instruction to A bank. Now, how is A bank essentially going to effect this transaction? What will A bank do? A bank will give this instruction to B bank, right? And B bank is going to debit this 50,000 into whose account? Into your account over here, because you are running some credit balance. So it is going to say debit 50,000. Are you with me? Are you with me? Yes or no?
Yes, sir.
Okay. All right. So I am going to essentially pay over here in 50,000. Now, if B bank wants to do a similar transaction in India, they want to pay in INR, they can also say that, okay, I have an account with you in India. Now remember, B bank has an account with you in rupee terms. So it will say, okay, you debit 1 lakh rupees and pay to so and so person. I will debit it into this account. So it is as simple as that. Opening accounts with each other banks, right? Now, that does not just facilitate the two banks, but most importantly, say for example, I have 10 million customers, right? If I have 10 million customers, I am in a position to serve each and every one of them. right? Are you with me? Okay, so this is how Nostro and Loro works. Are you all with me?
Yes.
Okay.
Yes, sir.
Just 1 minute, we go back to our question number 5. Okay, now let's start with this question again. Question number 5. Okay, XYZ Limited, Amsterdam, wants to purchase rupees 25 million against pound for funding their Nostro account. And they have credit Loro account with Bank of London. Calculate the amount of pounds credited. Ongoing interbank rates are per dollar 61.3625 slash 3700 and per pound dollar 1.5260 to 70. Yes, first and foremost, I have the rates available to me. So let me first of all note the prices which are already available to me. So what is the rate given to me? Do I have the USD to rupees or rupees to USD? Yes, rupees to USD is given to me,
Yes.
Sir.
right? So first of all, I have bid, then rupees. I have ask. Okay, rupees to USD. What is the rate? Bid क्या है? 61.36
3625.
and ask is 61.3700. Right? All right. Further, we are also given pound rate. So, and per pound, dollar 1.5260 slash 70. Tell me, this is pound per dollar or dollar per pound?
Dollar per pound.
It is dollar per GBP, right? Bid. And then I say it is ask. So what is the bid price? Bid price is 1.5260. 1.5260 and 1.5270. Right? Okay. These are the interbank rates available. Now, we are told XYZ Limited Bank, Amsterdam, wants to purchase rupees 25 million against pound for funding their Nostro account, and they have credited Loro account with Bank of London. Calculate the amount of pounds credited. Ongoing interbank rates are per dollar. Okay, so first and foremost, their home currency basically in which they have got is GBP. Am I right? So GBP, then you are going to convert GBP into USD, and then you want to convert that into INR. Am I understanding this correct?
Yes, sir.
Right? This will be the process or the route as such. So GBP will be converted to USD and USD will be converted to INR. Now I need to find over here what is the price at which it will work. All right. So I want to calculate over here rupees per GBP. Am I right?
Yes.
Bid. And then ask. So how do I go about doing that? We just now have done that. Right? We did this conversions, etc. So how do I calculate rupees per GBP? I know rupees per USD bid multiplied with, yes, multiplied with USD upon GBP bid. Am I right?
Yes.
So what is rupees upon USD bid?
61.3625.
Equals to 61.3625 multiplied with USD upon GBP bid is 1.526. Am I right?
Yes, sir.
So I get 93.63. Now, similarly, I need to calculate for ask also. Please try doing it on your own. Tell me what is the answer you are getting.
$93.711. No.
Are we all getting this? Yes? Yes, are we all getting this?
Yes, sir.
So GBP to be credited for how much money do you want? You want 25 what? 25 lakh, 25 million. You want 25 million. 25 million. 25 million is nothing but 2 crore 50 lakhs, right? Okay, so how much GBP to be credited? Wants to purchase 25 million. So they want to purchase rupees, which means they want to sell GBP. Am I right?
Yes.
So I'm going to essentially say 2 crore 50 lakhs divide by which rate?
93.7119.
Think again. You want to buy rupee, which means you are going to sell GBP. Am I right?
$93.6391.
Yes. 93.639175. So you'll get 266,982. Is everyone getting this? Right? So this is basically the computation which we did, that is 2 crore 50 lakh divided by 93.639175. So I will have 266,982 GBP to be credited to the account in order to get 25 million INR. Calculate the amount of pounds credited. We have calculated the amount of pounds credited. Have you all got this so far?
Yes, sir.
Okay. So what did we start with today? We started first of all two-way code, bid or ask. So bid is basically the nothing but sell price. In other words, this is the price at which foreign currency is sold by the customer. Ask is nothing but buy or offer, and this is the rate at which customer buys from the bank or the forex dealer. Right? The difference between ask and bid is known as spread or margin for the bank. So spread is generally computed as ask minus bid, ask rate minus bid rate, right? So spread is always calculated as ask rate minus bid rate, right? Then we saw a couple of examples how to convert the bid rate and ask rate. We also discussed about what is the direct quote in case of two-way currency quote, right? And then we did the indirect quote of the two-way currency, right? Thereafter, we have solved a couple of questions as well. Okay, we did question 4 today, question 5 today. There are a few more sums on the cross rate, which we'll be doing in the second half. Shall we take the break of 10 minutes now?
So still I am not getting that first problem, sir. That we
Which one?
have. So 15 million one. Now it is again repeated in last problem that we have done. 25 million one. That rate I am not getting, sir.
Achha, what is the exact doubt? Why did I use 51.3625? Is there
I am still thinking, sir, that we are paying more dollars or pound.
so first and foremost, in case of the previous case also, if you see ABN AMRO Bank becomes a customer over here,
Yes, sir.
of the Canara Bank.
Yes, sir.
So this was your bid rate and ask rate, am I right?
That I am understanding, sir, but through transaction I am not getting that thing. Bank is in loss, sir.
How is bank in loss? Which bank is in loss? You are talking about ABN AMRO or you are talking about Canara Bank?
ABN AMRO.
So ABN AMRO is not at loss. It is a customer, right? Because you will have to pay for the charges. There are no services which are available to you for free, my dear. Canara Bank is in the business of selling the foreign currency which you want to buy. So it is Canara Bank is going to tell ABN AMRO, if you want to buy the currency, which is rupee in this case, then you will have to pay my charges, right?
Okay. Okay, sir.
Getting it?
Thank you,
This
sir.
bid rate and ask rate is about what? It is selling. You are selling over here what? You are selling dollars, right? And bank is
Okay.
buying dollar. You
Yes,
don't
sir.
want to sell, you don't want to buy dollar, right? You want to essentially sell
Yes,
dollars.
sir.
ABN AMRO Bank, what is it doing? It is selling, right? It is a
Yes, sir. I was.
customer which is selling US dollar.
Yes, sir.
So that is the reason Canara Bank will buy it at 51.3625. And here,
Okay,
don't
sir.
think about ABN AMRO as a bank which is making a loss. Remember, it is just another customer. Because at the
Okay.
end of the day, bank is going to transfer that cost to their client, right?
Yes, sir.
So say, for example, if Canara Bank, I mean, practically speaking, I am talking about now practical, not in this example. But
Yes, sir.
in practically speaking, if ABN AMRO is paying 51.3625 to the Canara Bank, do you think they are not going to charge any charges to their customer?
Will charge, sir.
They will charge, right? So whatever is the cost on that, they will charge their charges. So Canara Bank's charges, you can see over here, margin is whatever is noted over here, right? 0.0075 per dollar. But as far as
Okay.
ABN AMRO is concerned, they will charge their own separate charges, which will be charged to their customer. That is not part
Okay.
of this question.
Okay, sir.
Okay? All right.
Thank you, sir.
Now, let us take a break of 10 minutes and then we will start again. Okay. So before the break, the last question that we had done was where we had to determine how much pounds are required based on the cross rate conversion from GBP to USD to INR. Now we go to question number 9 from our assignment sheet. Question number 9. Question number 9. You sold Hong Kong dollar 1 crore value spot to your customer at rupees 5.70 and covered yourself in London market on the same day when the exchange rates were US dollar 1 equals to Hong Kong 7.5880 and 7.5920. Local interbank market rates for US dollar were spot US dollar 1 equal to 42.70, that is rupees, and rupees 42.85. Calculate cover rate and ascertain the profit or loss in the transaction. Ignore brokerage. So here, first of all, what we are supposed to find is cover rate, meaning basically we are supposed to find what will be the cross rate, right? What will be the applicable cross rate for us in this value, in this transaction over here as per the prevailing rates. And then remember, we had essentially sold to the customer at rupees 5.70. So say for example, my answer comes to 5.50 or 5.60. Then 10 paise difference is the profit which will be made by the bank. But say if the answer comes to 5.90, then you have already sold it to your customer at 5.70. So you will be making 10-20 paise loss. So that is what is expected to be computed. We repeat again, the concept over here is essentially of converting our value over here. So you sold Hong Kong dollar 1 crore value spot to your customer at rupees 5.70 and covered yourself in London market on the same day when exchange rates were given. So what is given to me are the two rates, right? So let me start. What are the rates available to me over here? US dollar 1 is equal to Hong Kong. So is this Hong Kong dollar to USD or USD to Hong Kong? Hong Kong dollar to USD, am I right?
Yes, sir.
Yes. So bid. And then I have ask. Right. And then I have rupees to USD bid and rupees to USD ask. Okay, so what is the price over here? 7.5880 bid and ask is 7.5920. Then I have rupees to USD, which is 42.70 and 42.85. Okay, what is it that we are supposed to calculate? Have they told us we are supposed to calculate Hong Kong dollar to rupees or rupees to Hong Kong dollar? Is there anywhere mentioned in the question? Yes?
Hong Kong dollar is sold, so yeah, Hong Kong dollar.
Should it be HKD to INR or INR to HKD?
INR to HKD.
And how do you know that? Which information from the question tells you that you have to calculate INR to Hong Kong dollar?
Because I sold Hong Kong dollar.
At what rate?
It's around 5.70.
5.70, which means you have sold it rupees per Hong Kong dollar, right? So I need to calculate what will be rupees to HKD, right? Am I right? This is what we need to find. Now, first and foremost, I need to establish over here, I'm going to convert from which currency to which currency. So you have sold Hong Kong dollar 1 crore value spot to your customer at rupees 5.70. So I'm going to convert HKD to USD to rupees, right? This makes my job a lot easier to identify the currency flow is happening from where to where. I need to find rupees per HKD. So yes, what will be the bid and ask? Yes. So what will be the rupees per HKD bid? I need rupees. I need rupees upon USD bid multiplied by USD upon HKD bid. Am I right? Would that give me the right answer? USD gets cancelled. What will remain is rupees upon HKD.
Yes, sir.
Yes. Yes. So what is rupees upon USD bid? What is the rate?
42.70.
42.70. Right. This is 42.70 multiplied by, now USD upon HKD I want, but what I have is HKD upon USD. So this is
1 divided by 7.592.
This bid is ask converted, no?
yes. So
Yes,
bid
yes.
means basically, remember on conversion this will have to be become indirect code. So bid will become ask and ask will become bid, right? So here I will have to write 7.592. Are you all with me?
Yes,
Yes,
sir.
sir.
Right? Okay. Should it be 7.592 or should it be 1 upon 7.592?
1 upon
1/5.
1/7.
1 upon 7.592. Thank you. All right. So what I get is
5.6243.
Exactly.
5.6243. Okay, are you all with me?
Yes, sir.
Now here there is one note of caution for all of you. Remember, I am solving over here right now on Excel, so I have got so many decimal points over here. In the examination, you need to take at least 4 decimal points. Okay? I repeat once again, you need to take for currency purposes at least 4 decimal points.
Okay.
Because when I take this precise answer, otherwise your final answer obviously will change. Not that institute is going to cancel or deny you your marks, etc. However, you need to be careful about it, that for the purpose of examination, because you will end up only spending more time in typing extra values, right? So you need to be mindful of that. Okay. All right. Now ask price will be, how will I calculate ask? Yes, rupees upon USD ask. This is ask price is 42.85 into 1 upon 7.588. So I get 5.64. So I have calculated the rate now. Are you all with me now?
Yes, sir.
Sir.
Yeah. So we have calculated the cross rate or the cover rate and ascertain the profit or loss in the transaction. Okay. So how do I go about computing the profit or loss? So I'm going to prepare that over here. Okay. I'll compute the profit or loss over here. Amount received from customer on sale of 1 crore HKD. Sorry, Hong Kong dollar. Okay. So how much do I'm sorry?
The Hong Kong dollar sale rate which is given in the question is 5.70 minus ask rate, bid rate of what we have just calculated. Difference will be that profit per Hong Kong dollar.
Exactly. So that will be the profit margin for the bank, right? So I have essentially received 5 crore 70 lakhs, right? Less. What should be the cover amount as per the prevailing rates? You have sold HKD, right? So you will sell at what rate? 5.64 or 5.62?
62434.
I repeat, bid price,
6470.
sell price for the customer, and ask price is the buy price for the customer. As a customer, I am going to buy HKD or sell HKD.
By HDB. Yes, sir.
I'm going to buy HKD or sell HKD.
By.
The 5.6470 rate is used for that transaction.
Here, they are selling, so I am buying, right? So I have to essentially go as per the ask rate. Am I right?
Yes, sir.
Yes,
Amount received, amount. This is not amount received is already calculated. Amount as per
Bank.
the prevailing cover rate. What is the cover rate over here for me? Ask rate. Am I right? Ask rate, which is 5.6471. Okay. चलो तो ये कितना होगा इक्वल टू 5.6471. So what is the profit over here by the bank? 5,29,000 profit on the transaction. कोई शक, कोई सवाल? Yes.
Sir, clear.
Clear? Understood by everyone? This is all in rupees terms, huh? This is all in rupees. Got it, everyone?
Yes, sir.
Okay. So now, we have question. Now we go to the next concept. We had discussed this in brief in the previous session, which is about spot rate and forward rate. Okay. Spot rate and forward rate. What do you mean by spot rate? As the name itself suggests, spot.
Today.
Yes. If I want to convert this rate today, right? So if I have currency today and I want to do transaction on the spot, right? So this is the current rate today. right? Today. Now, logically speaking, it would have to be the rate which is available immediately today, right? Current rate. On the other hand, forward rate, as the word itself indicates, it is a rate which is at some future specified date, right? This is for at some future specified date. So it is a rate which is applicable on a certain future specified date. It may be 30 days, 60 days, 90 days, or 180 days, right? So you can calculate it at some future specified date. That is forward rate. Spot rate is available today. You go to the over the counter, reach out to the banker, tell him I have so and so dollars, I want to convert it into INR, or you have GBP or whatever currency, you will be available to you at current today's rate, right? While forward rate is basically at some future specified date, right? So spot rate is applicable for whom? Applicable for buying and selling, could be buying and or selling currencies at spot, meaning in current times, today, T, right? Today. On the other hand, forward rate is applicable for whom?
Buying or selling currencies in future date.
Exactly. Applicable for buying or selling currencies at future specified date. Okay. Now what this does is it provides a wonderful opportunity. If you recall, we had mentioned in one of the reasons for forward exchange, right? Business, because this transaction is going to happen in future, where I am quoting a forward rate, it allows me an opportunity to do something known as hedging my risk. What do you mean by hedging my risk? Any ideas? So you have over here, since it is talking about my requirement is going to be in future, the opportunity to hedging your risk, right? Your forex risk basically. So what is the meaning of this here? How can I essentially hedge my risk? If I don't want to take the risk of conversions, right? And also most importantly, not just conversion, most importantly, the risk is of fluctuating exchange rates, right? Like for example, currently there are many macroeconomic activities which are going globally around, right? Russia and Ukraine war, or you see there is some disturbance in Middle East, etc. Everything has an impact on your supply chain logistics. As a result of that, your logistics become expensive, your commodities become expensive, and as a result, there is going to be an impact on your demand and supply of currency as well. So I don't want to take a risk in future if I'm assuming, say for example, I have a particular liability 2 months down the line. Let's say after 60 days from now, I have to pay. Let's say I have to pay ruble 5 million, right? That is Russian ruble 5 million. I need to pay 2 months from now. Now, just last week there was escalation of war, etc. I know for a fact today is 25th November. By 25th January, that is 2 months from now, December, January, right? So this will become today is 25th November, and 2 months from there is going to be 25th of January 25. Now, by this particular date, I know for a fact that there will be a certain change in presidency. So, new President Trump will take over, right? And he has already said that, okay, I want to end this war, etc., etc. So, there is a possibility that the ruble rates may start stabilizing, might start appreciating because there is a change in the global leader's position, so to say. Alternatively, there is also a possibility that actually the rate might further decline, right? It's a two-edged sword. I don't want to take that risk. So in that case, what I do is I enter into something known as forward exchange contract, right? What is forward exchange contract? What is forward exchange contract?
I finalize the price at which I want to transact in the future date. Like I fix it at this current date.
Exactly. So it is forward exchange contract is nothing but you fixing your obligation for future payments, right? So you are already going to exchange a certain currency on a future date at future specified date, right? So I'm going to have this contract entered into at agreed rate, already predetermined rate, that is, so I'm not taking any risk. I know the cost today itself at future specified date. Now, in the future, if the price increase or decrease, either ways, I will not get the benefit of the profit, neither will I get the benefit of loss, right? Because I have already covered my position. This is foreign exchange contract, right? So we basically try to cover our positions. Now, often we also try to do that evaluation, right? Decision making. Should I cover my position? Should I not cover my position? So again, we are going to look at another question, which is question number 10. Let us look at question number 10, where again we will have the concept of cross rates, right? And now I have to essentially cover my position, and there is a twin possibility which is available to me. So I also need to determine whether I should cover my position in one market or the other. Okay. Let me take the question over here. It is question number 10 in the assignment sheet, which was already shared with you guys. I'm also putting up question over here. This is question number 10. I believe all of you have the assignment sheet. For those of you who don't have the assignment sheet, I have put up the question over here for your easy reference. Let us read the question. You are a foreign exchange dealer of your bank. Sorry. Are informed that your bank has sold a TT on Copenhagen for Danish kroner 10 lakhs at the rate of Danish kroner 1 is equal to rupee 6.5150 per kroner, right? So you are required to cover the transaction either in London or New York market. The rates on that date are as under. Mumbai, London, Mumbai, New York, London, Copenhagen, New York, Copenhagen. In which market will you cover the transaction, London or New York? And what will be the exchange profit or loss on the transaction? Ignore brokerages. Yes. So here I have two possibilities, right? For me, if you look at it, I can take this Mumbai London rate from London to Copenhagen. Are you with me? Yes. Similarly, I have Mumbai to New York available to me, and then I can go to Mumbai, New York, Copenhagen. So what is happening over here? I have two options. What are those two options? I go from Mumbai to London to Copenhagen, right? Mumbai to New York to CPH, that is Copenhagen. Now, Mumbai currency is rupee. London currency is what? What is the London currency? Yes,
GBP.
GBP. Very good. So London currency is GBP, and then London to CPH you have mentioned in DKK terms, right? Which is Danish kroner. Similarly, if I do from Mumbai to New York, it is going to be US dollar to DKK. Now the question that arises is, sir, I can do it from either of them. Why take the trouble of computing? Why do we do this computation? Any ideas?
तो more profitable कहाँ होगा ये देखने के लिए.
Exactly. Now this brings us to the concept of arbitrage. What is the meaning of arbitrage? Anybody?
Taking opposite position in two different currencies. Technically, when we learned,
Yes. So arbitrage means, basically, simple terms में it is called riskless profit or
Risk-free
gain.
return.
Riskless profit or gain, because you are going to incur the same cost, right? However, one of the alternatives essentially provides you better riskless profit. This arbitrage basically arises from mispricing of securities, mispricing of securities, and in our case, that is currencies. Are you with me? Right?
Yes,
So
sir.
what we are going to do is, we have to do the same process which we did for question number 9. We have to do the same thing over here for going from Mumbai to London to CPH, Mumbai to New York to CPH, and then we will try to identify which one is generating a better option for us. Because what do you need? You, a foreign exchange dealer of your bank, are informed that your bank has sold a TT on Copenhagen for Danish kroner, right? At the rate of Danish kroner 1 is equal to 6.5150. So you already are selling Danish kroner. So I want to find what is the final alternate, value you are trying to find. I want to find rupees to DKK. Am I right? Right? You have already sold 10 lakhs of Danish kroner at this particular rate of 6.5150. So the option which provides me more profit, meaning where the rate charged between these two options is going to be lesser, that is the option which I will exercise. Are you all with me? Yes?
Yes, sir.
So let's start. Let's start. I'm going to rub off the arbitrage part which I have mentioned over here so that I can start doing computation over here, right? All right. So now let us start. So I'm going to write down the routes. What is the route? Mumbai to London, and then London to Copenhagen, right? Okay. So when I talk about Mumbai to London, I am talking about, this is which rate? Mumbai to London is given as INR to GBP, and London to Copenhagen is mentioned as DKK, right? You see over here the quotation is given as DKK so and so. So what is the base currency? Base currency is GBP. Are you with me?
Yes, sir.
So what is the bid ask? And my ultimate objective is what? My ultimate objective is to find
Rupee per DKK.
rupee per DKK. Okay. All right. Now let's start. What is the rate over here? INR to GBP 74.30, 74.32. Let me select over here and say I want to have 4 decimal points. Okay. All right. Now London to Copenhagen, that is 11.4200, 11.4350. So rupees to DKK, how much will be the value over here? How will I calculate that? Yes,
The
I
rupee
want
per
INR in the numerator and DKK in the denominator, right? So this has to be INR upon GBP bid price into GBP upon
GBP upon
DKK,
DKK
right?
bid price.
So it has to be. Can I go slightly direct, or do you want me to write again how I have arrived at it? Right,
Correct.
INR upon GBP. So that is 74.30, right, multiplied by
1
now
by 11 point.
GBP upon DKK, right? So for GBP upon DKK, I will need to do the reverse. For bid, it will be asked, right? Into 1 upon 11.4350.
9.4350.
Very good. Thank you, dear. Now, for ask, it will be 74.32 into 1 upon 11.4200. Are we getting 6.49 and 6.50? Yes, everyone?
sir, calculation is 74.32, sir.
74.32, yes. Ask price is 74.32, yes.
6.5078.
Thank you. Got it, everyone? Now we need to do the same thing again. Same thing again. But now we will do it for Mumbai to
New York.
New York. Right? And then I will have New York to Copenhagen. So here I am going to have INR to USD. Then here I will have DKK to USD. Yes. So INR to USD rate is given to me. What is that? INR to USD. Question. Mumbai to New York 49.2500. 00. And then I have 49.2625. Similarly, then I have New York to Copenhagen, which is 7.5670 and 7.5840. Now I want rupees per DKK, so I will have to do essentially over here. The bid price is 49.25 into 1 upon
0.75670.
I want USD upon DKK, right? And that too, the indirect word, so ask will become the bid, right? 7.5840. Now you will find over here, as you get more and more, you acquire more and more confidence, then in that case, you will essentially be able to eliminate a lot of these things which you don't need to do, right? I am doing these steps for the simple reason that since we are starting off, you have a stronger base available, right? But in the examination, do I need to calculate all these rates? The answer is no. You don't need to calculate both buy and sell rates. You can essentially determine and identify whether it is a transaction where you will require the ask rate or the bid rate, and then you can calculate only that one particular element, right? 7.57 is it? Sorry, 5670. Okay. Is everyone getting this?
Yes, sir.
All right. So now I have computed the values. Now, can you please tell me what am I supposed to do over here? Am I supposed to be buying DKK or selling DKK? Yes. What is required? You, a foreign exchange dealer of your bank, are informed that your bank has sold a TT on Copenhagen for Danish kroner 10 lakh at the rate of Danish kroner 1 is equal to 6.5150. You are required to cover the transaction either in London or New York market.
What is a TT?
TT is a telegraphic transfer.
Okay.
It's like a bank draft, right? So if it is a local draft, like for example, when you pay to the bank, let's say I am asking that I want to pay to, let's say, one Mr. Amrendra 10,000 rupees. Now, maybe that Mr. Amrendra does not, trust that my check will get honored or not. So in that case, he is going to ask me for a demand draft, right, which is basically being issued by the bank. So similarly, in international trade, you don't have a bank draft, you have it called as telegraphic transfer, TT instrument, right? So bank has sold a TT of Danish kroner 10 lakhs, which means they have sold Danish kroner and they will get INR. Am I right?
Yes.
Okay. Are you getting it?
Yes, sir.
Okay.
Yes, sir.
So now, as a customer, here I need to take into account customer's position or bank's position. You are acting on behalf of whom? You, a foreign exchange dealer of your bank,
Thanks, sir.
Right.
are informed that your bank has sold a TT on Copenhagen for Danish kroner. So you have sold Danish kroner. Who has sold? Bank. You are a bank right now. Huh? You are not a customer right now. Are you with me?
Yes, sir.
Yes. Yes, sir.
If you have any doubts, ask me right now. Because you are acting, you are a foreign exchange dealer working in the bank, remember? And your bank has already sold a TT. So your bank has already sold Danish kroner. Now you are supposed to cover that position. What do you mean by cover that position? I need to bring that DKK from somewhere, right? Buy from somewhere. So how do I cover my position? So what is the bank required to do? Is the bank has already sold DKK. So if I have to deliver somebody DKK, do I need to buy the DKK?
Yes.
So I am going to buy the DKK at what rate? Bid or ask?
Bid rate. Bank buys at bid rate. No, bank becomes customer now. Then we have to think this way.
Bid is basically the sell rate for the customer, which means bank is going to buy it, right? But here, what is the quoted currency? Quoted currency over here, that is the base currency is DKK. So if bank is going to buy DKK at 6.4939. Are you with me?
Paid from New York, sir.
So New York, I can buy at 6.4939, and from London, I can buy it at 6.4976. I need to cover my position, remember? So customer is going to sell, bank has to buy. Since bank is buying DKK, so bank is going to pay you what price? As if customer is selling DKK, right? So that is a bid price. So between the two bid price, which one is lower?
New York.
You can do a simple mathematics. ज़्यादा अगर दिमाग नहीं लगाने का है. If you don't want to strain your brains, just do the computation. Which one is higher? One minus the other, right? So here, since I am talking about this is higher, London is higher, so it is going to cost me more because this is my outflow, right? So I don't want to buy from London. I want to buy from New York because that will save me money. What have we asked? In which market will you cover the transaction, London or New York? So my answer should be, I'll cover in which bank or in which market?
New York.
So we will cover the transaction in New York market at what rate? At rupees to DKK rate of, it is bid rate. Am I right? I am writing this more specifically so that there is no confusion for you when you are referring it back. Okay. All right. Now, further you, yes.
For taking this cover position, bank is purchasing. So don't we think that bank has become customer now?
My dear, bank is going to purchase from somebody, right?
Yes.
So that somebody will be the customer of the bank,
Yes.
right? So that somebody is going to essentially sell DKK. Wait a moment. So your bank is going to buy currency, right? It is going to buy from customer, right? So bank is going to buy what? Customer is doing buying or selling?
Selling to bank.
Customer is selling DKK, right? Now you tell me whether it will be a bid rate or ask rate. Which rate will be applicable?
Bid rate of bank.
Bid rate, right? So bid rate will be applicable because this is the rate at which customer sells and bank buys, right? So that is the reason you will have 6.4939 as the rate at which bank will buy.
Okay.
You have two options over here, either 6.49 if you want to buy from London or 6.4939 if you want to buy from New York. Are you with me?
Yes, sir.
Okay. All right. Now, what are being asked? In which market will you cover the transaction, London or New York? So we have already mentioned we'll cover in New York. And what will be the exchange profit or loss on the transaction? Now that it is already mentioned, so I need to compute the profit or loss. So So how do I go about doing that? Yes, how can I do that? Let me calculate from here. Yes, so what will be the amount of profit or loss? Amount received from customer on sale of 10 lakh, 10 lakh DKK, right? So this is sold at what rate? 10 lakh into 6.5150. Am I right? Is it 6.5150?
Yes, sir.
This is the calculation which I am putting it in red for easy reference, right? 10 lakh at 6.515. This is the rate which is already being mentioned in the question. And then you have covered your position at your bid rate, right? Which is 6.4939. Equals to 10 lakh into 6.4939.
Sir,
Yes, dear.
sir, here is arbitrage opportunity between New York and London market also now.
Yes, dear. So what we are asked is profit on the exchange, profit or loss on the transaction. You calculated 21,100. Now say for example, I want to calculate over here in the same question. Say for example, I want you to calculate arbitrage profit or loss. Can you help me calculate arbitrage profit or loss? How will you calculate arbitrage profit or loss?
Sir, buying in the New York market and selling in the London market.
Very good. So I am basically not going to do that if, of course, I want to do that particular transaction, assuming there are no brokerages, etc. Then yes, that particular strategy is also available. But in this particular case, what is the incremental profit or loss you have made? How do I calculate that? Or as you also said, if I do the buying in one and selling in the other one, how much is the profit I will make? So it will be into 6.4976 minus 6.4939. Would that be right to say so?
Yes, sir.
So if I'm
Think
selling
again.
it
Please
in,
think again. Please think again if
so
this
if
is
I'm,
the correct answer.
so if
Yeah,
I'm
because-
selling it in,
Yes.
so if I'm selling it in the London market, won't I use the ask rate that is 6.5079? Why is that? Why have you used 6.4976 in the equation that you just stated? With the London market, the ask rate is 6.5079.
5079.
Very good.
Huh.
So that is what I am
But
trying to ask you. Is this the correct answer? Because you will
Acha,
buy
no,
in
no,
one market
yes.
and then you will sell in another market, right?
Yeah.
Yes.
So
So
you have
your
to
buying is going
change
to be at what rate? 4939. Am I right?
4939.
But you are going to sell it in the other market at what rate?
6.5079.
6.5079. Right? So that comes to 14,000. Sorry. Are you with me?
Yes,
Yes.
sir.
Okay. This is not part of the question. This we calculated basically just for our understanding. Right? So I take this as a basically a point of initiation for our discussion on arbitrage. Is everyone clear so far?
Can we say zero investment with return? Fixed return.
Thank you. I'm sorry,
Sir,
come again.
sir, can we say arbitrage is a zero investment with fixed return?
Arbitrage is a
Zero investment at fixed return.
fixed return is not something which is guaranteed. Right? Now, say for example, if we are looking at, let me take this example. Now, say for example, what is the meaning of arbitrage first of all? Arbitrage can exist only if there is mispricing of same commodity, security, or currency in two different markets, basically. Am I right? Now, say for example, I have a particular, let's say, as we just now discussed, let's say it is London market, and then I have a New York market. Okay, let's say I'm going to take a commodity instead of a particular currency. So let's say I talk about a commodity like say wheat, for example, a particular branded wheat. Okay, particular branded wheat, say Kohinoor. So this particular wheat, assuming there is a free market available, right, and there are no interruptions in between, in which case, if this particular wheat is essentially commanding a price of, say for example, 56 rupees in London, 56 pounds, sorry, in London, and the same carries an equivalent value. I'm talking about equivalent value, okay? Equivalent value, or let's say for example, 52 pounds in New York. Obviously in New York it will sell in USD, but right now for a moment, I am taking the equivalent value in New York is 52 pounds. Now you can see over here that per kg, assuming this is per kg, okay, per kg, there is a price differential of 4 pounds. As long as the cost of transporting from one place to another is lesser than 4 rupees, it becomes a good business, right? So in that case, a lot of people will actually start trading. They will start importing wheat from London, start selling it in New York. There is another aspect which is there is when you are essentially buying and selling just the commodity stake, for example. Okay, so let's say for example, I am a dealer over here. I am a dealer. What I have done is I have essentially got a particular deal with, let's say, somebody in New York. Okay, that I am going to buy this at 52. I transfer that particular document to somebody in UK that, okay, you can go and take the delivery from New York, and I charge him 54 or 55 depending on what is the transaction cost, so that there is an incentive for him. I will make some profit which is arbitrage free. I can just book this transaction over here, take a document, sell it over here. But that is a transaction which is happening, right? Are you all with me? Now, what happens as a result of this? This is simple economics, right? As people notice, more and more people start noticing that there is a price differential over here, there is an arbitrage opportunity over here. More and more of the traders from London will start shifting to New York as demand over here will start increasing. Demand will start increasing. What will happen to supply? Yes. What will happen to supply? Can the same amount of, assuming the same amount of supply is there, do you think everybody will get the supply?
No, the supply when demand increases, the price has gone up.
Exactly. Supply increases, or even if it supply remains static, then in that case, price will essentially increase, right? So
Okay.
this particular price, which is there, 52, it will start changing towards equilibrium price. Similarly, in London also that same thing is going to happen. In London, what is going to happen is demand is going to decrease. Supply is going to either remain the same or it is going to increase now, right? Why increase? Because excess supply ho gaya now. Now it's excess supply, right? As a result of this, what will happen to the price? Since demand has gone down, price will also go down.
Price will come down.
And then both the prices over here, they will reach to a particular equilibrium price. Are you with me?
Yes, sir.
So it is a continuous search for an arbitrage opportunity. So just because today there is an arbitrage opportunity does not mean that arbitrage opportunity will continue in future as well, right? Every time there is an arbitrage opportunity, more and more people participating in it, more and more people exploiting that particular opportunity, both the markets will start resetting the price and they will both come back to equilibrium price. The moment there is an equilibrium price, arbitrage opportunity has become zero. Now you need to find another arbitrage opportunity. So the question which you asked, is there a possibility of me getting a fixed return or arbitrage? Right? There is no concept of fixed return on arbitrage because arbitrage opportunity is always fragile. Yeah, as long as you are able to say, for example, you buy from here 52 and you have immediately sold it to somebody at 56 over here, then yes, you can say I have a profit of 4. Right? Otherwise, you are not in a position to determine any fixed return. So arbitrage never gives you any fixed return as such because that always keeps fluctuating. Are you with me? Is that clear to all?
Arbitrage is only to minimize the risk.
Yeah, the purpose of arbitrage is basically I want to have a risk-free profit, right? That's the main purpose. Sorry. So that being the main purpose, there is no concept of fixed return on arbitrage. So just 1 minute, we'll continue again here further. All right. So right now, what we just now saw was a arbitrage opportunity. We just spoke about arbitrage in generic terms, right? By taking another commodity. But arbitrage in Forex, is this possible? We just now calculated there is possible that you can essentially buy from one market and sell it into another. Assuming there are no restrictions on moving from one market to another, right? So in arbitrage, what are the essential elements over here for foreign currencies? Remember, Forex values, they keep changing, right? Am I right? Yes or no? Forex values always keep changing. With the changing values, there is always a possibility of Forex values keeps changing. One more element in between is there is multiple markets and players, right? Always a possibility of mispricing opportunities. Now, what do you mean by mispricing? Because the word itself, it sounds as if there is something which is wrong which has been done. But the answer is no. When we say mispricing, meaning it is not at equilibrium price, traded at the same price between all the parties. Right? So that is the meaning of mispricing. It does not necessarily mean that anybody has made a mistake as such. Because the different markets may be having different demand and supply of a particular foreign currency. Right? So for example, let's say uh, when there is a we recently saw, because of the Russia-Ukraine war and Israel and Palestine conflict as such, there had been a certain shift. People were, or rather, I should say, central banks were shifting their forex currency holdings, right? Majority of them have their foreign currencies being held predominantly in dollars, right? But it was observed a lot of the banks were converting a part of their foreign currencies, dollars, into gold. What is the main purpose of that? What is the main reason of that? Any ideas? For your information, even RBI has purchased a lot of gold recently.
Gold prices have been going up, sir.
Gold
So,
prices?
assuming, I'm just guessing that in the current right now, the gold prices have been going up. So, in the future, we are expecting that the gold price would further go up, and hence to capitalize on the higher prices in the future. Maybe that's why, sir.
Now, what you're talking about is, see, you're again, I need to go to the very basic aspect, cause and effect, right? So the reason gold prices have been going up is mainly because a lot of the central banks have been increasing their gold reserves. So that is one huge factor in contributing to the increase in the gold prices. Like for example, if somebody says that Indians essentially consume or purchase a lot of gold, they invest in a lot of gold ornaments, etc., etc. Is that the fact? No, because there was a demand yesterday also, there is a demand today also. So if there is a change, say for example even 5%, then the price increase should have been only 5%. But gold prices, as you know, has really shot up huge deal. Do you agree with me? Almost 20-30% rise is there year on year. So what is the reason for that? The main reason being central banks across the globe, Central Bank of India, Central Bank of China, there are certain other central banks of Europe as well, which are increasing their holdings, forex holdings in terms of gold. And this may again continue further also. Remember, during the past Trump presidency, we had seen that they had essentially emphasized on that whoever is doing transactions in dollars, right, they basically weaponize dollars to control who does what. And as a result of that, also there were certain countries which felt a bit apprehensive. So they started selling their dollars and they started converting into other international currencies and gold. All this led to the price of gold appreciating. Now, how is this essentially affecting the forex currency? Because more and more people now start selling dollar. As a result, dollar being the international currency which is used in 80% of international transactions, that comes under pressure. And when that comes under pressure, US dollar depreciates, or rather their value depreciates, and as a result of that, the other currencies will also feel the impact, right? So there is a very, very strong possibility in that case in arbitrage, identifying the correct arbitrage opportunities. You may not get that in the most commonly traded securities, but in currencies which are not frequently traded. Like for example, we just discussed about DKK, right? Danish krona. It is not a very frequently traded security or a currency, and as a result of that, you find good arbitrage opportunities at times in these securities, right? Now, Just 1 minute. We have, I can't take up one another topic which is going to have a huge impact over here in the sense that in 12 minutes I need to complete this. So I'm going to take one simpler question over here, right, which basically talks about our net currency exposure. Let me take that particular question. It's not. Let me try it. All right. So this is question number 12 from the assignment which was shared with you, right? Question number 3. Is the question visible to everyone now? This is question number 12. Following are the following are the details of cash inflows and outflows in foreign currency denominations of MNP company and Indian export firm which have no foreign subsidiaries. So you have the different currencies: US dollar, French franc, UK pound, Japanese yen. We are given inflow is this much, outflow we are given the spot rate and forward rate, right? Further, we are asked to determine the net exposure of each foreign currency in terms of rupees. Are any of the exposure positions offsetting to some extent? Okay, so that is the subsequent part. First and foremost is, do we have any net exposure of foreign currency in terms of rupees? So how do you calculate this? So let me take it from here. Are you all able to see the question? Yes? All right. So what I want to know is determine the net exposure of each foreign currency in terms of rupees. So we are given the value of inflow, value of outflow. So I have a certain exposure. What do you mean by exposure, first and foremost? So I'm looking at what is the spread. At the spot rate, I am supposed to receive 48.01. Is that spread going to be positive for me or negative for me? Because this rate is quoted with the base currency being dollars, right? And you are going to essentially receive dollars. So if rupee depreciates, you can see over here, US dollar is appreciating, right? 48.01 becomes 48.82. Because what is the base currency over here? Base currency is dollars, right? So my base currency appreciates. You are going to receive your payment in dollar terms. So will it be beneficial for you or will it be
It's a
unbeneficial?
benefit for us.
Yes. So it will be advantageous for us, right?
Yes, sir.
Right. So here, if I am calculating over here spread meaning difference, right? So will this spread be beneficial for me, forward minus spot? I'm calculating the spread. for all the 4 currencies. Now you can find over here that I have over here, you can see, right? I have a positive spread available for US dollar, for French francs, for UK pound, for Japanese yen. There is a negative spread, right? Fair enough. But what is my exposure as such? Because am I a net inflow or a net outflow guy? So I'm going to find over here what is my net
The net outflow in case of Japanese yen only.
net flows. So I have net flows. What I do is I'm doing inflow minus outflow, right? So I can see over here I have a net inflow coming in and I have a positive spread. So this is going to be beneficial for me. For French franc, I have a net inflow, and again franc is going to appreciate, so it is positive for me. Similarly, for UK pound also, I have a net inflow and spread is positive, so it's going to be positive for me. In case of Japanese yen, I have a net outflow. Sorry, I have a net outflow. However, the spread is negative. So what is this going to do? Though I have a outflow position, but because the spread is negative, it actually benefits me by saving my money, right? Yes? Are you all with me? समझ में आ रहा है बेटा? So now what I need to calculate is net exposure, right? So what is my net exposure? Net exposure is going to be my net flows multiplied by the spread. Net inflows multiplied by the spread, right? Then I do the summation. Now do the total of the 4. So I find my net exposure is positive for me to the extent of 3,63,40,000 rupees. So this is my net exposure. Determine the net exposure of each foreign currency in terms of rupees. So we have found for each currency, and then we have also done the total also, right? Are any of the exposure positions offsetting to some extent? Can you find any offsetting one? Any exposure which is offsetting?
Yen.
Which is that
Yen.
currency? Japanese.
Yen.
In Japanese yen, though I have a net outflow, but because the currency is depreciating, yen is depreciating. Am I right? INR
Yes,
is appreciating. So that negative spread actually is offsetting the outflow position, and as a result of that, I end up making 80 lakh rupees in that as well, right? So are any of the exposure positions offsetting to some extent? You can write it is for Japanese yen, as the spread is negative and net outflows is there, thus it leads to offsetting position in net exposure. Is that clear to everyone? Okay.
sir. How to write this answer in verbal form?
Yeah, should I write? Okay. You can write over here. Japanese yen is having a negative spread which offsets the net outflow position for the what is the name of the client of MNP company, or the MNP company, right? Thus, in spite of negative spread, meaning negative spread it is talking about is where the currency is depreciating, right? Thus, in spite of depreciation of Japanese yen, it provides, sorry, it provides positive forex exposure, positive, yeah, it provides positive net forex exposure on, in spite of depreciation of Japanese yen, it provides positive net forex exposure due to negative outflow, net outflow position. Yeah.
Okay, sir. Thank you.
Okay. All right. So with that, I'll just recap what we did today for the entire day today in this session. We started with the two-way quote, the bid and ask, then conversion of the direct quotes into the indirect quotes for the two-way quotes, right? Then we computed cross rates. Then we utilized the concept of cross rate, right, to identify at what rate I can essentially buy or sell a particular currency in these examples, right? And then we started the concept of arbitrage opportunity. Remember, arbitrage was not asked in this question, but we just took an example, right? Because that is the difference between the London and New York market in the given example, right? So with that, we conclude our session for today. Thank you.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Ashok ji, are you there? Yes, sir. Yes, sir.